Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer, here to provide an update on the markets and the economy following the first quarter of 2026. So the first quarter was a turbulent one for markets. The S&P 500 was down 4.3% overall, with the bulk of that decline concentrated in March. Geopolitical tensions, stress in private credit markets, and growing concerns that AI may threaten certain industries all weighed on sentiment. That said, there were some bright spots. For example, we observed that the average stock in the S&P 500 actually outperformed the index as a whole by nearly 5% as market leadership continued to broaden out. The biggest driver of market weakness, though, was oil prices. Crude oil surged nearly 13% in January on supply concerns, but it was the U.S.-Iran conflict and the closure of the Strait of Hormuz, a choke point for roughly 20% of global oil flows, that sent prices surging nearly 50% in March. Rising energy costs feed directly into inflation, and because inflation was already firming before the conflict, expectations for Fed rate cuts shifted dramatically. Markets entered the year pricing in 2 to 3 Fed cuts by year-end, but by the end of the quarter, those cuts had been fully priced out, with a rate hike even entering the conversation. The next theme driving market rotation was the shifting perception of AI. For the past 2 years, AI was broadly viewed as a productivity tool, but several AI product launches in January and February led investors to begin to reprice AI as a potential replacement for entire categories of professional services. The software industry was hit particularly hard, declining nearly 30% from its October peak, one of the largest non-recessionary drawdowns in over 30 years. Finally, concerns around private credit grew after several large alternative asset managers began halting or limiting fund redemptions, fueling fears of overvaluation and evoking memories of 2008 for some investors. And although Fed officials have indicated they see no systemic risk, uncertainty continues to weigh on the financial sector. Now, heading into the second quarter, the key development to watch is the situation in the Middle East. Prolonged elevated oil prices raise the risk of stagflation, meaning rising inflation alongside slowing growth, which would be a challenging environment for most assets. We'll be monitoring these key themes for resolutions in the second quarter, but it's important to note that still stable economic growth and corporate earnings have provided meaningful support throughout the volatility. And that volatility has also served as an important reminder of the value of diversification. Many of the market's recent leaders underperformed during the volatility, while much of our equity exposure across different sizes, sectors, and geographies generally fared better than the broader S&P 500. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.